Energy and precious metals, weekly review and outlook speculation earlier than truth. It's the cause for rate moves that get overdone in any market, especially commodities. What if 25% of the modern-day oil rate is made of hypothesis by using Wall Street's biggest, however inadequately regulated buyers? What if that speculation is shut down? Will a barrel cross from $110 to $80? Intriguing. Read on. As commodity traders caught in the throes of U.S. recession fears sent a barrel down extra than $10 for the just-ended week, an investigative report via TYT Network that regarded on Salon.com said a handful of congressional Democrats had grew to become their attention as properly to an arcane trading loophole that may be assisting drive gas and food charges beyond justification. The loophole, known as footnote 563 under the buying and selling guidelines of the Commodity Futures Trading Commission, or CFTC, has been flagged to the Biden management by way of California's Democratic Representative R. Khanna, who desires it closed down. According to CFTC subject matter professionals interviewed by means of TYT, it is footnote 563 that mainly permits Wall Street's largest monetary firms to crush wholesome price setting with large volumes of commodity-based swaps, which are basically bets on commodity costs. In healthy markets, shoppers and sellers set fees via locating center floor between them. One celebration wishes low charges, the alternative desires high fees. The trouble is shoppers and sellers of oil and other commodities are outnumbered by way of something like 10 to 1 by way of Wall Street buyers, none of whom have a proper buyer's incentive to preserve costs low, because few of them ever without a doubt purchase it. They more often than not guess on it, because deregulated investors dramatically outnumber them. Authentic buyers and sellers are surely beside the point now in terms of putting charges, says Michael Greenberger, former Director of Trading and Markets at CFTC. Footnote 563 is what is inflicting Ukraine and other deliver issues to create disproportionately large impacts on fees, Greenberger instructed a virtual speak hosted currently through Americans for Financial Reform. To be sure, sanctions now not just on Russia, however additionally Iran and Venezuela, in addition to civil strife in Libya, are all squeezing international crude deliver even as call for is again to pre-pandemic highs. The hassle is Wall Street banks and buyers are amplifying charge spikes from this tight oil situation wherein a functioning futures market would cushion them. The problem isn't always corporate greed, as President Joe Biden and the Democrats have counseled. Or, as a minimum, it is now not the company greed that they've in mind. In healthy markets, price gouging would encourage aggressive undercutting, mainly with gas at record highs above $5 a gallon. In concept, an opportunistic fuel wholesaler ought to try to scoop up new customers by using lowballing their price gouging competition. But even supposing a few wholesalers did that, it wouldn't flow the marketplace charge, due to the fact fuel income are a drop within the bucket in comparison to Wall Street's bets. As Greenberger stated in his talk closing week, oil companies may additionally advantage from spiking expenses, but they are not the number one mover, and Greenberger has extra than a little enjoy with the problem. He played a comparable function returned within the aughts while gasoline crowned $4 a gallon, declaring a regulatory weak spot referred to as the Enron loophole that let Wall Street speculate on energy. In 2008, each presidential applicants, John McCain and Barack Obama, pledged to shut the Enron loophole. Then, the financial crisis erupted and oil went from $147 a barrel in July 2008 to underneath $33 by January 2009. Wall Street banks on their personal close down their commodity trading desks and stiff economic rules did the rest. Despite this, by means of February 2011, the Arab Spring and Libyan battle that preceded the downfall of Muammar Gaddafi took oil again to $100 a barrel. It remained between there and $90 till past due 2014. But Wall Street banks weren't trading commodities like earlier than. And gasoline expenses not often went above $3.50 a gallon. Thus, inflation wasn't a hassle. In truth, the Federal Reserve turned into praying that it'll hit its inflation target of 2% a year and became reducing quotes beneath a quantitative easing cycle that ran from 2008 through 2014. Even the greatest financial hawk then would possibly have struggled to assume the cutting-edge inflation of 8% a year. Then something else took place. Oil fees crashed from 2014 and could now not go back to $100 for any other 7 years at the least. Despite the relative marketplace lull then, Greenberger said the CFTC beneath Obama found the footnote 563 as a new capability threat after the Enron loophole.